Speaking of the Fed, we do have some breaking headlines now from New York Fed President John Williams, who is speaking as we speak. Steve Liesman, our senior economics reporter, has the comments for us. Steve?
Yeah, Scott, New York Fed President John Williams saying he expects the Fed to maintain a restrictive policy stance, quote, for some time. He says the Fed can reduce this policy restraint when they're confident inflation is moving back to the 2% target. On quantitative tightening, the unwinding of the Fed's balance sheet, he says the Fed is not yet close to the point where it should begin reducing QT. He sees inflation slowing to 2.25%, reaching target in 2025. So kind of optimistic there on the inflation front. And he does see two-sided risks on inflation, both the risk of it remaining stubborn, as Josh was just saying, versus the risk of a weaker than expected economy. He says the inflation situation has, quote, improved significantly, and is beginning to see significant progress in the core services inflation, as well as the core services ex-housing, which he says has slowed considerably. That's the metric that is watched carefully by Fed Chair Jay Powell. He says indicators of inflation expectations have been quite encouraging, and wage inflation has also come into better balance. If you're seeing a trend here, I'll get back to it in just a second. Still has a ways to go, he says, to get inflation back to target. And he sees the current unemployment rate prevailing over the long run. That is the current 3.7% unemployment rate, which is quite striking, though he does see it going up to 4% this year. The labor market, he says, is returning to better balance, and job growth has slowed considerably. He expects growth of just 1.25% this year, and the unemployment rate to rise to 4%. So, Scott, I'll leave it there, but what's remarkable to me about these remarks is he's saying all the things that he's looking at are going in their direction in terms of inflation, the job market, the economy slowing, but he's not giving you anything in terms of the Fed's outlook for cutting rates this year. He even sees reaching target by 2025, just 2.25% inflation this year, but doesn't really say anything about reducing rates.
He talks about the need to, he used the word, I believe you said, confirm that inflation is moving down to target. So what does that mean in Fed speaker speak? How many more CPI reports, for example, do these folks need to see until they can be confident that it is confirmed that inflation is moving towards target?
Yeah, the word I think is confident, Scott. I think is the word that he has used and others as well. And I don't know. I mean, we'll see. I think it's interesting. Josh introduces some risk to tomorrow's CPI report. I don't think that's wrong in that the market has priced itself very one-sided for inflation to be coming down in a straight line. We know the data don't behave that way. I do think there's some possibility of a downside surprise tomorrow because I'm thinking that finally the housing component starts to come down as has been expected for many months, especially because we've got some new data that shows rents have been declining throughout the country as well. So we'll see if that's incorporated into the CPI. But there's definitely risk of an upside surprise somewhere along the way. And I think the only answer I can give you, Scott, is that it's got to take several months of the inflation being down, coming down, heading towards target, where they can say, you know what, if we were to cut rates here, we would not be making a mistake and have to make what I think they believe is a worse outcome, which is to have to reverse course and hike again.
All right. Well, we've got a few CPIs before March, right? I mean, we're going to get the reads that maybe tell the story that moves the needle to the point where, it plays the record that people want to hear. Steve, thank you very much. That's Steve Liesman, our senior economics reporter.